The President of the United States is often credited, or blamed, for the state of the nation's economy. Campaigns revolve around promises of economic growth, job creation, or curbing inflation, and many voters decide based on whether they believe a president can deliver on these promises. But how much power does the president actually wield over the economy? While the president has significant influence, the reality is that their control is limited, and the broader economy is shaped by a mix of policies, global trends, market forces, and congressional action. The economy's performance under different presidents provides some of the most visible examples of perceived presidential influence. For instance, under Bill Clinton in the 1990s, the U.S. economy experienced one of its most robust periods, with 23 million jobs created and the national deficit turning into a surplus. Clinton's leadership is often credited, but many factors, including the tech boom and globalization, played significant roles. Similarly, under Barack Obama, the economy recovered from the 2008 financial crisis. But critics note that recovery policies were built on groundwork laid by George W. Bush's administration in its final months. One of the clearest ways the president can affect the economy is through fiscal policy. By proposing budgets, advocating for tax reforms, or pushing for stimulus packages, presidents set the tone for economic priorities. For example, Franklin D. Roosevelt's New Deal programs in the 1930s are credited with alleviating the effects of the Great Depression, while Ronald Reagan's tax cuts in the 1980s spurred economic growth but also significantly increased the national debt. However, fiscal policy is only effective if Congress cooperates. In 2023, President Joe Biden's ambitious economic agenda faced hurdles in a divided Congress, demonstrating how presidential proposals can be stalled or diluted. Even in cases of full party control, as seen during Donald Trump's presidency when Republicans held both chambers, compromise is often necessary to pass legislation, further limiting direct presidential influence. Presidents also wield indirect influence through appointments. The Federal Reserve, which controls monetary policy, operates independently but is shaped by presidentially appointed governors and chairs. The Fed's decisions on interest rates and inflation often have more immediate economic consequences than presidential actions. For instance, under Jerome Powell, appointed by Trump and retained by Biden, the Fed's aggressive interest rate hikes in 2022 to 2023 aimed to combat inflation, but also risked slowing economic growth. Trade policy is another tool presidents use to influence the economy. Trade agreements, tariffs, and sanctions can have widespread effects on industries and workers. Under Trump, the introduction of tariffs on Chinese goods was intended to protect American manufacturing, but it also led to retaliatory tariffs that hurt U.S. farmers, resulting in a $28 billion bailout for the agricultural sector. Similarly, Biden's focus on domestic manufacturing through the Inflation Reduction Act has encouraged investment in green energy but raised questions about long-term costs and international relations. Despite these tools, external factors often overshadow presidential influence. Global events like oil price shocks, pandemics, and geopolitical conflicts can rapidly change economic trajectories. The COVID-19 pandemic is a stark example. While both Trump and Biden implemented policies to manage the crisis, such as the CARES Act and subsequent stimulus measures, the economy's recovery depended largely on vaccine rollout and global supply chain stabilization. Market forces also play a dominant role. Stock markets, while often used as a barometer of economic health, are influenced by investor sentiment, corporate earnings, and global trends. Presidents often take credit for stock market gains, but their direct impact is limited. For example, during Trump's tenure, the Dow Jones Industrial Average rose by nearly 56%, a success often cited by his administration. However, the Federal Reserve's low interest rates and corporate tax cuts were key drivers of this growth. Long-term economic trends further dilute presidential impact. Demographics, technological advancements, and global trade dynamics shape the economy in ways that no single president can control. For instance, the decline of manufacturing jobs in the U.S. began in the 1970s due to automation and outsourcing, long before any modern administration. Similarly, the tech-driven gig economy has created jobs but also challenges for labor rights and income equality, issues that presidents have struggled to address comprehensively. Public perception often overestimates presidential influence. In a 2021 Pew Research survey, 56% of Americans believe the president had significant control over gas prices. In reality, gas prices are influenced by global oil markets, production levels set by OPEC, and refinery capacities, factors largely beyond presidential control. Yet presidents are often blamed for price spikes or credited for reductions, underscoring the mismatch between perception and reality. When assessing the true extent of presidential power over the economy, it's crucial to recognize the interplay between policies and the broader system. While presidents can set priorities and shape narratives, their impact depends on collaboration with Congress, the independence of institutions like the Federal Reserve, and external events. This doesn't mean the presidency is powerless. Rather, its influence is nuanced, indirect, and often overemphasized in public discourse. Ultimately, understanding the president's role in the economy requires moving beyond simplistic narratives. Presidents can guide economic policy, appoint key decision-makers, and advocate for structural reforms, but they cannot single-handedly dictate outcomes. The economy is a vast, interconnected system shaped by countless variables. And while leadership matters, it is rarely the sole determinant of success or failure.